In today's video, we're going to talk about how you can get a life insurance policy with a big death benefit and have a lot of cash value without having to pay more money. What we're going to use to demonstrate this is a case that we're working on right now where someone is considering a fairly large life insurance policy where estate planning is the goal, but they also want to have a lot of cash value. So what they want specifically is a policy where they're going to have either a $5 million death benefit or a $10 million death benefit. We're going to look at both options. But what they don't want is a policy where they just pay a big premium and that benefit is paid when they die. They said, I still want to see my cash value grow in the event that I want to use it for whatever. I know it's there. This is possible. So in a case like this, where we are looking at a large or complex estate planning situation, the policy owner is usually not the individual who's getting the life insurance policy. Now, they're controlling that policy, but it's typically set up where an LLC is owning the policy, and then that LLC is held within a trust. Very simple to follow, right? Complex things that a lot of individuals do that have high net worths for estate planning and also asset protection. Now, with all of this said, again, they want access to the cash value. So to simplify, what they want here is they want to get a life insurance policy that has a death benefit of either $5 million or $10 million, and they want to see a lot of cash value. What they want to do in terms of funding, though, is not be told, here's how much you must pay. They don't like that approach. They have an understanding of how the cash value works. They said, we want to fund this policy with $250,000 per year for 7 years. That gets in a little bit less than $2 million into the product. So they're saying, here's how much I want to pay and give me this. Is that possible? It is, but there is some give and take. So here's typically how I like to approach a situation like this. We'll look at typically one policy with one company to start and look at a policy with a $10 million death benefit, a $5 million death benefit, and then also the minimum death benefit possible. And what we'll do here, here's the key on this, is keep the funding exactly the same. So if this is you, you say, here's how much I want to pay into this policy. Cash value is a goal, but the death benefit's important. Let me know what questions I should be asking. What should I be aware of here? I would say, okay, where I would start is looking at this $250K per year going in, and we can start with a large death benefit policy. And you'll see you start with a $10 million life insurance benefit, and the cash value grows over time. But then we'll look at that exact same product and lower the death benefit to $5 million. And what you're going to see is you'll have a lot more cash value. And then the last thing I would look at, because I'd want to see it if you and I flipped positions, is the minimum death benefit possible to start with the same company, same product, same out-of-pocket, and see how much more you have in cash value. And then we can review both the life insurance amount and the cash value as the years pass. Make sense? We're keeping the same out-of-pocket for you, but looking at different values in terms of a starting death benefit. So what you'll notice here is less death benefit will equal more cash value, but also less death benefit up front and more cash value up front often results in more death benefit long term, which is interesting to hear, isn't it? Let's take a look. So we're going to look at these scenarios. Let's start with the $10 million scenario. And what that means is we're going to start with a $10 million death benefit. So we've got the illustrations up here, and I'm not going to spend too much time on the PDFs, but here you can see the $10 million death benefit. We've got the $5 million death benefit, and then we also have the minimum death benefit. So all of those numbers with respect to the cash value and death benefit figures will match up with what we have here. So what we are going to start with is, again, the $10 million death benefit. So what do you notice in this particular illustration? On the left, you've got your $250,000 per year. This is what they want to pay into the policy. The first year, they have a cash value of just over $200,000. So they have the bulk of what they paid into the policy available in cash value, and their death benefit is $10 million. This is for a 58-year-old female. Now, they continue to pay this $250K for 7 years. That takes her through the age of 64, because at 65, she doesn't want to fund anything anymore. They know exactly what they want to do in terms of paying money into the product. So there's your funding. What is highlighted in yellow represents your break-even point, which represents the first year that the cash value is equal to or greater than your total out-of-pocket. And the death benefit here, what do you notice? Stays level at $10 million. So they don't pay anything in, and the cash value continues to appreciate, but eventually we see an issue, which I'll get to in a moment. But first, let's take a look at this. At the 10th year, what do you have in policy value? Well, we see that your cash value is just about $2 million, and your death benefit is still $10 million. How about by year 20? What do you notice? Well, the cash value, $2.3 million and change, death benefit, still 10. Year 30, what happened there? What happened in this particular example? Cash value came down, and so did the death benefit, because by keeping that death benefit so high at $10 million, the $250 that we illustrated going in for only 7 years wasn't enough. The cash value did not compound at a rate fast enough to continue to cover the insurance expenses, particularly a term insurance rider. And what can happen in cases like this, as we see on the illustration, the company calls for money again. What that means is we have to come up with that out of pocket, or the policy will lapse, or it'll start to borrow against itself, which we don't want to occur. That makes these numbers over here look even worse. So the $250 per year for 7 years with a $10 million death benefit, does that work? Not really. Not if she lives past 86, then things start to go down. She's got less in cash value than what she paid into the product. I wouldn't want this. It's not that attractive. So there is a solution to this, which we'll look at the end of this video in terms of her wanting the $10 million death benefit. But first, or I should say next, let's look at the $5 million death benefit. So here we go. Is the out-of-pocket any different? No. $250. Is the cash value different? Yes. First year, instead of $200, you're close to $220. Your break even is year 4 instead of year 5. Let's see what things look like over time. We'll go through the same exercise. First, we'll look at policy year 10. So by the 10th year, what do you notice here? Cash value is about $2.2 million. Do you remember what it was in the $10 million death benefit? It was $1.97 million. So you've got a lot more cash value here as a result of setting the death benefit lower. Next, by year 20, what do you have? $3.35 million in cash value and still $5 million in death benefit. And how about by year 30? Which, year 30, death benefits are now $6 million, a lot of cash value. She's 87. So at 87, that's where we're looking at when the death benefit might be paid out. When you look at average life expectancy tables from life insurance companies, a lot of times it falls right around age 85. Statistically speaking, they know when most of us are going to kick the bucket. Now, that's the $5 million death benefit. Between the two, which one would you go with? 10 million or 5 million? I'd go with 5 million if that was my funding. However, there's one last option I would look at. Here we go. What's the out-of-pocket? Still exactly the same, $250 per year. for 7 years. First year cash value is almost identical to the $5 million death benefit. It's less than $1,000 more. But what happens as time passes? Do the exact same thing. By the 10th year, you're at 2.2. Death benefit's only 3.6 million. So we're starting with a lot less here. By the 20th year, look at your cash value. 3.6, death benefit's 4.7. How about by year 30? 6.5, almost 6.6 in death benefit. Do you remember what you were in the $5 million death benefit? Closer to 6 million even. That's your cash value in this particular example. So starting with the minimum death benefit, did what for you in terms of the long-term death benefit? Gave you the most value. Here's something that is great to try to remember. With a whole life insurance policy, the policy that has the most cash value will have the most death benefit long-term. The reason why is when you look at the death benefit, typically right around age 100, the cash value and death benefit are equal. So if you set up a policy or have your agent set up a policy for you where the cash value is maximized from start to finish, that usually results in a lower death benefit to start, more cash value to start, but long-term, more cash value and death benefit. Maximum cash value means maximum death benefit long-term. Let's compare the $5 million death benefit and the minimum death benefit. Here they are side by side, and here's a table that shows the difference. So starting with the cash value, if I go with the minimum death benefit, I've got more cash value from start to finish. While it starts out small, it does become noticeable over time. By age 80, there's $360,000, almost $370,000 more in cash value. We've got the same company, same product. The only difference is the design. Specifically, we started with less life insurance, which simply means we have a lower cost, which means we have more cash value. That's the key right there. The death benefit, however, I've got more in the $5 million example through about 78. Then as time passes, the minimum death benefit has more. And that's usually a choice for folks where they look at that and have to decide, do they want to start with less up front or just have a 5 million all the way through in case something happens earlier. One item to consider is if I go with the minimum death benefit and I really want 5 million, what I can do is look at a 20-year term for a 58-year-old individual here for $1.2 million. That way it covers that gap for 20 years. I could actually do it for 15 years easily here, but let's assume I cover the gap for 20 years. And what that does for me now is I can get that at a very low cost. It's not going to cost me $200,000 over 20 years. No, it's not going to cost that much. But now I can get that life insurance protection and still capture the cash value benefits. And that would be something that we would look at and discuss internally and then propose to the individual we're working with if that's a concern, the higher death benefit there. Cool stuff though, right? Let's wrap up the numbers by looking at one more scenario, which is assuming she says, hey, I really want that $10 million death benefit for estate planning. My attorney recommended it based on my current net worth and what it's going to grow to over time. I want this. However, long-term, it doesn't work, where that value starts to go down. So how can you make this work? Well, we would need to come up with additional cash. So what's the total amount she pays in here? $1.75 million over 7 years. Here's an alternative, which works very well if we've got excess cash on hand. It's not for everyone. We're starting with a lump sum, $740. We fund it for 10 years. We get a total of $3 million into the policy. By the 10th year, you've got close to $3.6 million in cash value. So that's $600,000 more than what you paid. Remember, we have access to this the whole time. Also, if we set it up correctly and don't mess it up, that access is also tax-free, which is nice. The death benefit, however, is always paid out income tax-free. So I've got that $10 million death benefit all the way through, and eventually what happens with this is it does increase. I mean, it's not until way down the road, but we never run into a situation where the cash value or death benefit goes down. So this is one example of a case where someone wanted a big death benefit to start. They wanted to have cash value, but they did not want to be told you have to pay more into it. So in that case, rather than just saying, no, you can't do that, right? Ever been told that? Instead of that, we can look at different options. This way, they can see everything up front and then decide if they want to adjust the funding or roll with one of the options that they are shown. So the last item to mention here are the next steps for this individual, because when you're working with estate planning cases, there's usually more than one person involved. Like, it's not just her. You've got individuals in the family, there's an estate planning attorney. Here's typically what the process looks like, with this family and a lot of individuals we work with in situations like this. Number one, review companies. This is after we've discussed their financials and what they want to do with the policy. Review different companies, review different products, work on design. This is what we just talked about over here. Meet with the attorney, communicate with them, make sure everything is understood by all parties. This way everyone is on the same page. This can take some time, especially if the attorney is not familiar with whole life insurance setup for high cash value and flexibility, all of that fun stuff. But that's very important to do. It really should not be missed or should not be skipped this step. Then, when it's a go from all parties, begin underwriting. This includes an application and in most cases a medical exam. During that underwriting process, the attorney is going to prepare documents if needed. Those documents could be to set up an LLC and then also a trust if the family does not have a trust in place already. And then what we'll do is, after approval, review the approved numbers and then start the policy. All while maintaining the client's goals. So I hope you enjoyed this case study. This one was a lot of fun. If you look at this and say, hey, those numbers are huge, you can chop off a 0 or 2. And as long as all things are done proportionately, meaning we design the policy for your particular situation with the death benefit and cash value and funding you're looking at, you'll see a similar story in terms of the numbers, just reduced by the amount that you decide to fund it with. So I do hope this helps. Let us know if you have any questions at all, and thanks so much for watching.